Welcome back to The Breakfast Show. It's 9:10 on a lovely Tuesday morning here in KL. And right now it's time to bring on our resident financial coach. Now, last week, Yap Ming Hui spoke to us about investing our hard-earned cash.
Like us, most of you had questions about how and where. So today we're going to talk about one option available, unit trust.
And to help us do that, of course, joining us again is Mr. Yap. Welcome back, Mr. Yap.
Hello.
You've had very busy Tuesday mornings these past couple of weeks.
Yes. I've made a commitment to myself.
All right. Thank you very much. You know, every day every Tuesdays we always walk away with a financial tip.
Yes.
A lot more savvy, yeah?
Yes. That's the whole idea, to make the TV host more savvy, to make everybody in front of TV also more savvy in money management. That's the whole idea.
So today we're talking about unit trust.
Yes.
Now, how does this work when it comes to growing your money for you?
Basically, unit trust actually allow us to pool the money of all these small investors so that we can actually create a pool of the money to invest in the stock markets, into bond, so that we can actually diversify our investment even though our money is as small as 1,000 ringgit. But the problem is that a lot of people, when they invest this unit trust, they do not really know how much it costs them when it comes to actually investing in unit trust, because remember, there's nothing free in this world.
Yes, of course.
So I'm not so sure whether you're aware of any charges involved when investing in unit trust.
I'm sure there are some of your investment, the money goes to the agent and then the guy who's actually handling your funds.
Yes.
Because unlike stock market, where if you're savvy, you go direct, you can do it yourself, monitor it. But unit trust, you actually hand your money to people.
So today I'm going to share with you three charges, three main charges actually involved when you invest in unit trust. Actually, number one is what we call sales charges, paying to the agents, the person who sells it to you. Number two is what we call fund management fee. Number three is what we call advisory fee.
All right.
Okay, let's go to number one first. Number one, sales charges normally is charged you at the front end. Say, for example, they also call the entry charges. So if we talk about that, this kind of charges normally actually involve, like, for example, if you invest in this equity kind of fund, or balance fund, it will charge you between 5 to 7%. Okay, and if you invest
of your total investment.
Of a total investment. Okay. So if at 5 to 7%, if you actually invest 100,000, which means to say this 100,000 will minus, say average 6%. So your 100,000 will be left with 94,000 to start with.
Okay.
Yeah. So that is about equity or balance funds. If you actually were to invest into like money market funds or the bond fund, the entry charges will be 0 to 3%. 0 to 3%. So as you can see, physically, literally, when you actually invest 100,000, you need to minus off the front end charges. You are actually, in a way, lost. You're actually at loss of 6% when you start investing in it. So there's the actual impact. So that's why there are some companies actually, they do not actually charge front end sales charges. What they actually charge is that they charge back end charges. Back end charges, which means to say they don't charge you when you invest 100,000.
They take from your profits.
What they actually do is that they will actually charge you when you exit.
Right.
You know? So for example, that some of them actually apply in such a way that if you actually invest 100,000, you continue to grow to 110,000, 120,000. Only if you actually exit within, say, 1 year, 3 years, then they charge you a charges. And a lot of time they start charging you at first year exit, maybe 6%. Then over the years it diminishes. So that maybe you stay for 6 years, then only you exit, then they don't charge you any charges anymore.
Right.
So this at least is more fair to the consumer. So this is what we talk about, the sales charges. Whereby the company charges the fee, mainly to pay to the salesperson.
Yes.
Number two is fund management charges, because to manage the funds, you need a lot of costs actually involved. You need to employ professional. So under the fund management charges, there are three. Number one is we call that investment management fee. So investment management fee, what we call that, it actually involves, like, for equity fund, actually it charges you about 1.5 to 2%. So that is on an annual basis. And then for bond fund, it's about 1 to 1.5%. For money market fund, actually it's 0.5%. So that is the money you pay to the investment manager who's experienced, professionally qualified. Number two, fund management charges is trustee fee. Because in every unit trust, there is actually trustee involved holding the money for investor. So trustee fee normally is about 0.07%. Okay, that's less than 1%, 0.07% per year. Okay, that's a trustee fee. Plus also other miscellaneous operating expenses, like the expenses involved in actually getting a lawyer to check the agreement is correct, the audit fee to make sure the accounting is correct, phone bill, all the expenses involved in running that fund, all be charged back to the unit trust investor. So this is the second part of the charges that you need to be aware of. Okay. So basically, when we actually invest in unit trust, whether you buy through the unit trust agent or the bank, these are the two main charges that we actually going to incur. Now there's a third charges now. Since the year 2008, the third charges that we have got, which we call advisory fee. Advisory fee is whereby when you actually go and buy unit trust from what we call corporate unit trust advisor. This corporate unit trust advisor is a new licensed financial advisor who are licensed by security commissions. So what they do is that when you go and buy unit trust from them, you get charged extra. You get charged extra of 1%. But it comes with some benefits.
Yes, some benefits.
What happens is that when you actually invest through this corporate unit trust advisor, you pay 1% more extra. But what actually happens is that you will be able to invest into what we call a wrap account that would actually allow you to invest into more than 12 companies. More than 12 companies. Because normally when you actually invest between, like for example, one company agent, you only invest into one company's fund, another company, another one company's fund. But here, you're going through this corporate unit trust advisor, it will allow you to invest more than 10 companies. So you can pick a lot. You become like a supermarket. You know?
Okay, so with all these fees that you're telling us, so give or take, you pay about 9% of your initial investment to these three different fees. So
that's very sharp calculations.
Yeah, well, you know, roughly. So what is your advice to people then about how do they overcome this? How do they make up for this loss?
Just now when I mentioned about the corporate unit trust advisor, you pay 1%. Number one, it allows you to invest into more than 12 companies. Okay. At the same time, also it will actually charge you a lower sales charges. Yeah. So the advantage of going to corporate unit trust advisor is that it allows you to go to lower charges. It range the fee charge instead of 5 or 6%, it go down to 0 to 3%. So for example, sometimes if you were to like say I got the existing unit trust portfolio I want to actually sell it off. I want to restructure it. I want to move to this corporate unit trust advisor. They even allow you to enter at 0%. So you can see the benefit there. Okay, and then the third benefit is that what happens is that along the way, when you actually invest in unit trust, some fund, for example, it is a particular China fund, you may find that it's not performing that well. You want to sell this fund, China fund, from company A and go and buy from company B. So normally, if you buy through the unit trust agents or the bank, then when you sell this one fund, you get the money back. You're going to buy a second fund. It will cost you again 5 to 7%. So there's another round of 5 and 7%. But if under this wrap account provided by corporate unit trust advisor, it's going to be 0%.
So are you saying that one of the best unit trusts to invest in would be this corporate?
I would say, in conclusion, two ways.
In conclusion.
Now, actually, there's two schools of thought when it comes to unit trust investing. One school of thought is that you believe that you can buy fund. This fund is good, fund A is good, fund B is good. You buy and you hold. Like I say, Aisha, hold until your baby reach 18 years old. So you believe if you go and buy and then hold it, then you go and buy through the normal unit trust channel. It's very easy because you only have to pay front end sales charges 5% or 4%, one off. And then you just hold it. But if you believe, say, wow, unit trust, you should not invest like that because market environment is very volatile. There's always new fund coming in, better fund. Some good fund may be good now, become bad later. So what you need to do is that you need active management. So if you believe in active management, I would suggest you go for this corporate unit trust advisor. Because when you're actively managing, selling, buying, and then selling again, buying again, it's all free.
So a lot of people will be like, but you know, I don't have the knowledge. You know, when do I sell? When do I buy? So therefore, the corporate unit trust advisor that's when they come in and they actually give you that advice.
These people, they'll be actually qualified person, who've been trained into unit trust investing. In fact, I mentioned before, they are licensed by Security Commission as well. And at the same time, you can see when they actually operate in such a platform, they do not make money asking you to sell the fund and buy another fund. You see that? So the only way they can make money is that if you invest 100,000 with them, the only way they can make money is that they grow your money from 100,000 to 150,000 to 200,000. Then they charge 1% on that. So in the way that put them on the same side of the table.
So they actually make money from your returns, right? Not whether or not the fund does
but not like churning. The technical is churning. So for example, if we were to meet, of course, some unit trust agents are professional, but you mean not so honest or professional unit trust agent. They may ask you
rogues.
They just want to sell and sell.
They want to sell and make the profit at the expense of yours. So if that actually happen, what actually happen is that they call churning. What churning happen is that I sell you 100,000, you invest 100,000 with me, I charge you 5% already. Then after that I say, oh actually Joanne, this one no longer good only. Then I ask you to sell this one. Okay, and then I'm going to ask you to buy another fund.
Because they make money from every transaction.
Every transaction. So in this case, at the end of the day, unit trust company is the one who make money. The agent is the one who make money. But the investor who come up with 100,000 at risk
ends up broke.
So that's why these are the charges that we need to be very mindful about when we actually invest in unit trust.
There you go. There is a lot to know when it comes to investing, not just in unit trust, investing your money anywhere for that fact. So therefore, for a lot of people who want to know more, you actually have a financial mastery workshop coming up. Can you tell us a little bit about that?
Basically, this Saturday and Sunday, 16 and 17 on Sunday, I will be holding a workshop, which is going to be my maiden workshop talking about how to manage money. Because so far I see in Malaysia, we got a lot of workshops talking about how to make more money, how to create more money. But there's no one workshop to talk about what do you do or how do you manage or optimize the money that you have already created. So the idea is that this workshop I will be sharing 68 strategy as to how we can optimize the money that we have got. So I really look forward to this.
So have it work for you. You know, we're working all our lives. We work for our money. Have it fun. You work.
Make money work for us.
And I know, financial stability has become a lot more important for you now because you have a child. And it's very interesting because this week, Mr. Yap is actually providing one free seat to a single mom. To come, and not that you're single, but to a single mom to come to attend his workshop. And if you're interested, all you have to do is either email Mr. Yap at enquiries@yapminghui.com, or you can SMS your entry to 012-3900-048. And all you have to do is tell Mr. Yap why you want to attend this financial mastery workshop.
There you go, an opportunity not to be missed. Also, for more information on Mr. Yap, his workshops, or this topic, you can always visit Mr. Yap's website. That's www.yapminghui.com. All right, thank you very much for being on the show with us, Mr. Yap. We'll see you again next Tuesday.
Yeah, definitely. Okay.
Thank you.
As we mentioned, we'll see Mr. Yap again next Tuesday with more financial tips and tricks on how to make the most of your money.